Hey, this is Ryan Chen from LoanKit. In this video, I'm going to show you what qualifies you for SBA and what gets you denied. Now, the first thing I'm going to cover that determines whether your SBA loan gets approved or denied, and most business owners have never even calculated, is called the debt service coverage ratio. And if yours is below 1.25, you are not getting funded. That one number kills more SBA applications than credit score, collateral, and time in business combined. But even if your DSCR is solid, there are still 5 other requirements that can disqualify you before an underwriter even opens your file. And on top of that, the SBA changed its rule in 2025, so a lot of business owners who would have qualified a year ago are now getting denied without understanding why. So today I'm going to walk you through the entire SBA loan process from start to finish. The loan types, the current rates, all 6 qualification requirements, including the one most people have never heard of, the step-by-step process to go from application to funded, and the 5 mistakes I see kill deals every single week. And I know this because I have personally funded over 300 business loans, not with my brokers, not with my reps, what I personally touch. Real deals from real experience and real underwriting. Let's get into it. So first thing first, what is an SBA loan? What the SBA does is guarantee a portion of the loan that a bank or non-bank lender gives you, which means the bank takes on less risk, which means they are more willing to approve you, even if your financials are not perfect. On a standard 7A loan, the government is guaranteeing 75 to 85% of the loan amount, depending on the size. So if you default, the bank only loses 15 to 25% instead of the whole thing. That is why SBA will approve loans for business owners that will normally be churned away on a conventional deal. And the reason this matters to you as a business owner is because SBA loans gives you longer terms, lower rates, and lower monthly payments than almost any other form of business alternative financing available. We are talking 10 to 25 years at rates that are currently sitting around 10 to 13%, depending on the loan size and structure and bank and your own personal financials and credit profile. Now compare that to cash advance, where you are paying 50 to 250% effective APR with daily withdrawals hitting your account, or even a conventional bank loan, where you might get 3 to 7 year terms at best. A $500,000 SBA loan over 10 years at 11% is roughly $6,900 a month. That same $500,000 through an MCA at 1.3 as the factor rate paid over 12 months is over $54,000 a month in daily debits. That's the difference between building your business and borrowing debts you potentially cannot service. And by the end of this video, you're going to know exactly how to position yourself on the right side of that math. And that is why SBA loans are worth fighting for. But when most people hear SBA loans, they think it's one product. It is not. There are actually several different programs, and picking the wrong one can cost you weeks or get you denied entirely from that specific bank. There are a few SBA programs, but the 3 you actually need to know as of right now are the 7A, the 504, and the Express. The 7A is the standard flagship program that most people borrow. This is the one where most people are referring to when they say SBA loan. You can borrow up to $5 million. You can use it for almost anything: working capital, equipment, buying another business, purchasing real estate, or refinancing existing debt, except MCA debt because of a new rule they installed recently. You cannot refinance MCA debt with SBA note. It is the most flexible product in the SBA lineup. Terms go up to 10 years for working capital and equipment, and up to 25 years if you're buying real estate. Rates right now are variable, tied to the prime rate plus a spread that the lender sets. With prime sitting around 6.75% as of early 2026, you're looking at roughly 9.75% to 13.5% depending on the loan size. Smaller loans get a higher rate because the lender is allowed a bigger spread. With that being said, the 7A is not the fastest program out there. You're looking at 60 to 90 days from applications to funding on a typical deal, and that is if every single thing goes smoothly. Now the 504, that's a different animal. This one is specifically for buying commercial real estate or fixed heavy equipment with the real estate. You cannot use it for working capital. The structure is unique because it's actually a 3-party deal. A bank covers 50% of a first mortgage, a certified development company backed by the SBA covers 40% of the second mortgage, and you put down 10%. Or if it's a cash out, you don't put anything down. But the reason business owners love the 504 is the rate, not cash out. If it's a refinance of existing debt, you put down 0%. The SBA portion is fixed for the life of the loan, and right now those rates are sitting 6.3 to 6.5%. That is significantly cheaper than the 7A, but you can only use it for real estate and fixed assets inside of real estate. So if you're buying a building for your business or a major piece of, let's say, factory equipment that's inside the building, this is the one that you want to look at. Then you have the SBA Express, which is the fastest version of the 7A. Max loan amount is $500,000. The SBA gives a response within 36 hours, and you can be funded in 30 to 45 days. The trade-off is the SBA only guarantees 50% instead of 75 to 85. So lenders are pickier about who they approve. Now, bear in mind that the Express is great for business owners who need a line of credit or quick access to working capital, but still want SBA terms instead of MCA pricing. There are also SBA microloans, which go up to $50,000 to nonprofit lenders. These are designed for startups and early stage businesses. The average microloan is about $13,000. Rates are 8 to 13% or terms up to 6 years. If you are just starting out and you need a small amount of capital, this is the most accessible product. So those are the programs. But knowing which loan to apply for is only half of it, because none of this matters if you do not meet the qualification requirement. And this is where I see the most business owners get blindsided. The first criteria is your credit score. For most SBA lenders, you need a personal credit score of at least 650, but realistically 680 or higher is where you start getting real traction. The SBA also used a business credit score called the SBSS, and of last year, the minimum went up from 155 to 165. So the bar has gotten higher. Number 2 is time in business. There's no official SBA minimum, but almost every lender wants to see at least 2 years of operating history or file tax returns to prove it. If you're a startup with under 2 years, it is not impossible, but you're going to need a strong business plan, industry experience, and at least a 10% equity injection. Number 3, and this is a big one, cash flow. Specifically your debt service coverage ratio, or DSCR. This is a number I told you about at the top of this video. Now, this is just a fancy way of saying how much cash does your business generate relative to what you own every month. The SBA minimum is 1.15x, but most lenders want to see 1.25x or more. That means for every dollar of debt payments, your business needs to be generating at least $1.25. And here's the part that trips most people up. Lenders calculate the DSCR based on your tax returns, not your bank statements. So you've been writing off everything aggressively and your tax return shows low income, net operating profit. That is what the underwriter is going to use. Even your bank account looks healthy. The tax returns are what actually matters. Now, number 4 is collateral. This changed significantly last year. The threshold for requiring collateral dropped from $500,000 all the way down to $50,000. So if you're borrowing more than $50,000, the lender is required to take all available collateral. That includes business assets and personal real estate if you have equity in it. Now, the SBA loan says the loan cannot be denied solely for lack of collateral, but in practice, having real estate equity with significant business assets absolutely helps your approval. And number 5 is the personal guarantee. Every owner with 20% or more ownership has to sign an unconditional personal guarantee. There's no way around this. It's a hard requirement on every single SBA loan. And number 6, this one changed recently. 100% of the business ownership now has to be held by US citizens nationals. If any owner is on a visa, H-1B, E-12, whatever it is, the business is ineligible. Now, this caught a lot of people off guard. One thing I want to mention here, if any owner has delinquent federal debt, that is student loans, back taxes, or prior default of the SBA, the application is dead on arrival. Check that before you even start the process, because it will save you months of wasted time. Now, those are the requirements. But even if you check every single box, the way you actually go through the application process determines whether you get funded in 30 days or spend 6 months going back and forth and still get denied. Stick with me here, because the next part is where this really comes together. And if you're already looking at these requirements and wondering where you stand, and we help business owners figure that out and get funded every single day. If you want to see how we can help you, I will leave a link in the description below where you can fill out an application. It takes about 60 seconds, and the team will review your situation and walk you through your actual options. Now that you know the loan types and what it takes to qualify, here's the exact process we use to take our clients from application to funded. Step 1 is pre-qualification. Before you even fill out an application, you need to figure out which SBA product fits your situation. And if you're buying real estate, that is a 504. If you need working capital quickly, that might be the Express. General purpose falls under the 7A. Getting the product right from the beginning saves you weeks. You also want to find a preferred lender, which is called a PLP lender. These are the banks that have been given authority by the SBA to approve loans on their own without sending the file to the SBA for review. That alone can cut off 2 weeks from your timeline. If your lender is not PLP, you're adding an extra layer of waiting that you do not need. Step 2 is gathering your documents, and this is where people slow themselves down by scrambling to find paperwork after they already have submitted the application. So here is what you need ready before you apply, so your file never stalls in underwriting. 3 years of business tax returns, 3 years of personal tax returns for every owner with 20% or more, a current profit and loss statement within the last 90 days, a current balance sheet within the last 90 days, 3 to 6 months of business bank statements, a debt schedule listing every existing loan, lease, and obligation. The SBA Form 1919, which is the borrower information form, the SBA Form 413, which is your personal financial statement, and SBA Form 912, which covers your personal history. If you're a startup or acquiring a business, you also need a detailed business plan with month-by-month financial projection and a written assumption page. The underwriter needs to see that you are aware of your economics and what you are building. And step 3 is submitting the application and entering underwriting. Once the lender has your package, an underwriter is going to go through everything. They're going to look at your cash flow, your credit history, your collateral, your management experience, and the industry risks your business possess. This is also when they order an IRS tax transcript to verify that your return matches what you submitted. If there are discrepancies, that is a major red flag. They will also pull business and personal credit reports and order an appraisal if real estate is involved. And that's where I see deals die. The underwriter sends you a list of conditions, which are basically questions and additional documents they need. Every day you wait to respond is the day your life sits in the bottom of the pile. If you want to close fast, response to conditions within 24 to 48 hours be the easiest file on that underwriter's desk. Step 4 is approval. If everything checks out, the lender issues a commitment letter with the term of the loan. If they are a PLP lender, they approve it themselves. If they are not, they submit a package to the SBA for credit authorization, which adds another 1 to 2 weeks. Step 5 is closing and funding. Legal documents get prepared, lien searches get run, insurance get verified, and you sign. Funding typically happens within 1 to 2 weeks after closing. As far as total timeline goes, best case of a PLP lender and a clean file, you're looking at 30 to 45 days. Typical is 60 to 75 days. But if you're dealing with real estate and acquisition or a non-PLP lender, it can stretch 90 to 120 days. The biggest single variable is you. The faster you get documents in and respond to conditions, the faster this moves. Now at this point, you know the loan types, the requirements, and the exact processes. But there are a couple of mistakes that can get people denied, and they are the things that every business owner who has never been turned down wish they knew before they applied. And the first one is insufficient cash flow. Their DSCR does not hit the 1.25x threshold that lender wants. And again, this is based on your tax returns, not bank statements. So if you have been aggressively writing off expenses to lower your tax bills, you might be hurting your credibility to borrow. There's a real tension between tax strategy and lending strategy, and most business owners do not think about it until they're sitting in front of an underwriter. Number 2 is inconsistent documents. The income on your P&L does not match the tax return. Your business address on the application is different from what is on file with the IRS. An owner with more than 25% is not listed on the forms. These inconsistencies triggers red flags, and underwriters do not give you the benefit of the doubt. They just deny the file for any sorts of red flag. Number 3 is applying for more than you can service. If the monthly payment on your loan you're requesting pushes the DSCR below 1.25x, you will not get approved for that number. Know your DSCR before the lender calculated it, so you are not wasting time on that application that is doomed from the start anyway. Number 4 is not disclosing everything up front, like bankruptcies, lawsuits, prior SBA loans, or criminal history. All of this has to go on the form. When the lender discovers something during the background check that you did not disclose, it is treated as fraud risk and the file gets killed immediately. And number 5 is using a non-PLP lender when you do not have to. Some business owners go to their local community bank because they have a relationship there, but that bank does not have PLP status. So now your file has to go through the SBA for review, which adds time and introduces another layer of scrutiny. If speed and certainty matter to you, use a PLP lender. Now the good part is that every single one of these mistakes is avoidable if you know exactly what to do before you apply. First, check all 3 credit bureaus before you apply. Dispute any errors. Get your personal credit score above 680 if at all possible. Check your business credit as well. Second, have your accountant reconcile your tax returns with your financial statements before you submit anything. If the numbers do not match, fix it first. Do not let the underwriter be the first one to discover the discrepancy. Third, know your DSCR. Calculate it before the lender does. Net operating income divided by total annual debt service. If it is tight, identify legitimate add-backs like owner salary above replacement cost, one-time expense, or depreciation. These are adjustments that can be documented and presented to the underwriter. Fourth, separate your personal and business banking completely. Commingling funds are a nightmare in underwriting. Clean business-only bank statements are significantly easier for an underwriter to verify. Fifth, eliminate any federal delinquencies before you apply. If you own the IRS, get on an installment agreement at the minimum. If you have defaulted on a student loan, resolve it first, because these are automatic disqualifiers. And 6, respond to everything fast. When the underwriter sends you conditions, get them back within 24 to 48 hours. The business owners who close fastest are the one who makes the underwriter's job easy. And if you want to make sure your file is one of the easy ones from day one, this is exactly what we do at LoanKitter. We got over 1,000 loans funded, 50+ institutional partnership, and a 60% approval rate across our application base. So if you want to look at your numbers and tell you exactly which SBA product fits your situation, there's a link in the description below where you can fill out our application in about 60 seconds, and our team will walk you through our options. Thank you for watching, and I'll see you in the next one.